At the end, it didn't move that much the needle. We call that a risk management speech by Mr. Powell. Yes, the Fed is on hold, but they remain very data dependent. They are ready to hike again if data don't go into their direction. And that means that the market will continue to watch data very closely. Data are expected to be volatile, so the markets might stay volatile. So the way we trade that is first, we want to use volatility at our own advantage. So, use kind of dollar cost averaging. Any pullback might be buyable. Two, we want to diversify further into the laggards of the market, those who have been behind in the first half of the year. And three, because bond yields might continue to move higher, we want to use that as an opportunity to lengthen the duration of our fixed income portfolios, which have been underweight duration until now. And it's probably a good time to think about lengthening the duration indeed on the back of, let's say, the Fed message.
If only some of the governments around the world had lengthened their duration, they wouldn't be in the refinancing problem that they've got now, Charles-Henri, which is a great point as well. But in terms of equity portfolios, a lot of equity traders seem to be constantly trying to dare the Fed to pause and to cut as well. They just don't really like the line that actually we're going to be higher for longer, that we could well be on pause for a very long time. In fact, we could even still see pauses and skips followed by more hikes to come. Is the broader equity market ready for higher for longer?
Well, markets don't like uncertainties, and we get uncertainties on that front, that's for sure. Also, what is clear is that there is competition, for equity markets, in the sense that indeed, there is yield in cash, there is yield in corporate bonds, and there is yield now on long duration bonds. So that creates an issue for equity market. That being said, if you look, for instance, at the earnings dynamic, it has been quite resilient. Earnings momentum is expected to, let's say, improve going forward. And if you look earnings revision after the second quarter earnings season, it is again, let's say, heading north, which is a good news for equity markets. So there's a kind of balance between the fact that valuations are under pressure because of the bond markets, and on the other hand, earnings are reflecting the fact that nominal growth is quite resilient, and that helps the top line. The margins are in very decent shape. So I think that there is this kind of, let's say, balance currently, which is helping the equity markets to stay where they are. We believe that a consolidation is probably likely to happen. This is already happening. But if you look at the medium-term outlook, it remains quite constructive for equity markets.
Yeah, Charles-Henri, good morning to you then, Arabile here. Are there any warning signs for you? You're talking about that bond market. I mean, we saw the 10-year last week even hit that 4.36 mark, should I say. Is 4.5 perhaps worrisome? Is that perhaps a level you look at and think to yourself, well, that could even impact equities actually, because of the attractiveness then of that 10-year, more risk perhaps in play over the next decade. Does that worry you? Does that, signal alarm bells if we see 4.5 before the end of the year?
I think that the big question mark for the markets is that, if bond yields move higher because the growth, is higher than expected. Look at, for instance, Fed Atlanta nowcast, pointing towards 5.9% annualized growth in Q3. Is it bad news for equity markets? Not necessarily. But the issue for equity markets is the following. If bond yields moving higher means at some point some stress for corporates, some stress for governments, that could be, a bad news. And again, it's because of the very high valuation, where now we have an equity risk premium at 39 basis points in the US. That's a 19-year low. That means that, again, you have this competition for yield, which is moving some flows from the equity markets to the bond market. And that, let's say, creates, the main stress for the equity market at this stage.
We still have high valuations, though, in these markets, don't we? Particularly US and state-wise. What pushes any kind of correction, if any?
Well, the trigger, by definition, we don't know in advance what could be the trigger for a correction. But, usually the correction is not necessarily coming from macro data. It's coming from financial stress. you basically before you alluded about, let's say, the market's movements by some retail stocks, for instance, the US, showing that maybe the let's say the consumer is not in the great shape. And also what is a bit worrying is the market action by banks. Look at the regional banks in the US, they continue to be under pressure. Big banks like Citigroup are also, hitting new lows. So the market is telling us that something is happening there, and that could be the trigger for correction. Again, yes, valuations are high, but there are some, let's say, also pocket of strength in the markets. Some of the laggards are coming back. Think about energy stocks, for instance, or consumer staples. So maybe the market action would be more balanced in the first half. But yes, some highly valued stocks might be under pressure in the weeks to come because of these higher bond valuations.
Charles-Henri, I want to try and turn attention very quickly just to China then. Where's that growth story gone exactly? I mean, we're seeing them perhaps add a little bit of impetus, that stamp duty getting cut in half, and yet the call is actually for greater government spending. Why are we not seeing that?
Yeah, I know the announcement of the weekends are going to the right direction, but what the market is missing is this big bazooka, from a monetary and fiscal stimulus, which could indeed help growth to accelerate. The reality is that China is currently facing a severe property sector decline, which is weighing on growth and also creating stress in some of the, let's say, financial markets in China. Think about wealth management products, for instance. And it seems that the Chinese government is reluctant to come with these big bazooka because they don't want to create new bubbles. So here, the base case for us is that they will at best stabilize growth, which is not enough to trigger a strong rebound of China market. That being said, there are some interesting segments which are, could be of, let's say, interest for global investors. Think, for instance, about the platform companies. The crackdown over the Alibaba's, Tencent of this world is over. They reported double-digit revenue growth, and they are trading at P's which are much cheaper than their US peers. So even though we don't expect, let's say, a huge rebound of China stocks going forward, there are some segments of the market which look quite attractive.
Charles-Henri, I was just looking at your reasons for and reasons against in your copy, a deeper correction from here. And as you said, you think short term we could be in for more consolidation, which means potentially that you've got an opportunity to buy this market at a cheaper level if indeed we see a continuation of that. Where will you place that money when and if, and the big if, we get further correction from here?
Well, our view is that, at this stage, you need to run diversified portfolios. So that means also looking at some of the extremes which have been created. I think there was a very interesting chart by Bank of America over the weekend showing how, the US outperformance against the rest of the world has hit extreme levels in terms of standard deviation. So it is a reminder that there are also opportunities outside the US. By the way, the PEs of, let's say, non-US indices are lower as of now at the start of the year. So that's one opportunity. And also within the US markets, yes, we like some of the growth stocks. Some of them are too expensive. But on the other hand, if you look at the free cash flow yield of energy stocks, they are very interesting. Some of the consumer staples and healthcare stocks also look attractive. So for us, let's say the name of the game is diversification. Go for quality, look at the strength of the balance sheets, and very importantly, free cash flow generation.
Quick word on that European call you just made there. Some of the P ratios are cheaper now than they were at the start of the year. Charles-Henri, there's a reason for that. It's called recession in Europe, isn't it?
Yeah, you're right. And also, when we're looking at the recent, let's say, PMIs and iPhone numbers, indeed, European growth is again under pressure. There are also question marks about energy. And last but not least, let's not forget that Europe is really the continent which is the most exposed to China and Asian growth, which is also under pressure. So yes, you're right, there is a reason, but that doesn't mean that we need to throw, all of the European stocks. We need to look at some of them as interesting opportunities. And this is what we are doing, in our portfolios, keeping some European stocks exposure, but knowing the fact that, yes, indeed, the dynamic in terms of growth is changing. This is also, by the way, why we came back on the dollar after having riding, let's say, the euro strength in the first half of the year.